The Euro-USD pair is at a crossroads, teetering on the edge of a potential breakout that could reshape its trajectory. But here's where it gets controversial. The same data that's fueling bullish optimism might also hide a bearish trap. Let's dive into the numbers, the narratives, and the strategies that could define your next move in this high-stakes Forex battle. And this is the part most people miss, the interplay between inflation, interest rates, and technical patterns isn't just a numbers game. It's a psychological chess match between traders and central banks. Ready to see how the pieces are moving? Let's break it down. The bull versus bear playbook. If you're leaning bullish, consider entering a long position with a target of 1.1750. To protect your capital, set a stop loss at 1.1570 and keep your eyes on the 1 to 2 day time frame. On the flip side, a bearish trade would involve shorting the pair at 1.1570 with a stop loss at 1.1750. These levels aren't arbitrary. They're rooted in recent price action and macroeconomic signals that we'll unpack next. The CPI conundrum and Fed frenzy. After the US CPI data dropped to 0.2% in July, from 0.3% in June, the Euro-USD surged to 1.1695, a 2.45% rally from its August 1 low. But here's the twist. While the annualized CPI stayed at 2.7%, missing the 2.8% forecast, core inflation hit 3.1%. Its highest in months. This mixed bag has traders split. On one hand, weaker goods inflation suggests Trump's tariffs haven't spiked prices as feared. On the other, core inflation stubbornness could delay rate cuts. Most analysts still bet the Fed will cut rates in September, but should we trust that narrative? The data says maybe, but the market's reaction tells a different story. The Fed's rate cut riddle. Federal Reserve officials are already hinting at cuts. Thomas Barkin of the Richmond Fed has openly supported the idea, while others like Christopher Waller and Neil Kashkari are waiting for more data. The July NSP report, just 73,000 jobs added and a 4.2% unemployment rate, has only fueled the debate. But here's the elephant in the room. The BLS revised June and May job numbers downward, averaging 35,000 monthly additions. Does this signal a weak labor market or a temporary blip? The answer could determine whether the Euro-USD breaks above 1.1830 or stalls. And this is the part most people miss. The Fed's communication is as important as the data itself. A single word in a statement could send the pair skyrocketing or crashing. Technical analysis, patterns and possibilities. From a technical standpoint, the Euro-USD has been dancing around 1.1670, well above its 50-day and 100-day EMAs. The chart has formed a bullish pennant, a consolidation pattern that often precedes a breakout. But here's where it gets controversial. The inverse head and shoulders pattern, a classic reversal sign, suggests the pair might continue its upward climb toward 1.1830. However, some traders argue that the recent sideways movement could be a false flag, luring buyers into a trap. What's your take? Is this a continuation play or a setup for a sharp reversal? Share your thoughts in the comments below. The road ahead. The next major catalysts will be Germany and Spain's consumer inflation data. These numbers could either confirm the bullish thesis or expose cracks in the Euro-USD's momentum. For now, the pair remains in a tight range, but the technical indicators are leaning toward a breakout. If you're ready to act on these signals, check out our free Forex signals and partner with one of Europe's top brokers to execute your strategy. Crispus Nyaga, the author of this analysis, brings over 8 years of expertise in financial markets. With a background at ATFX, Easy Markets, and OctaFX, and contributions to platforms like Seeking Alpha and Capital.com, his insights are backed by both theory and real-world trading. When he's not dissecting charts, you'll find him enjoying a round of golf or spending time with his family. But here's the question that keeps him, and you, up at night. Will the Euro-USD finally break through 1.1830 Or will it face a wall of resistance there? The market's answer could redefine your trading strategy. What's your bet?